Looks like we're live.
Think so. Let's see. Yep, looks like we're live.
Just waiting on some viewers to come in.
Yep.
So is that just on your side? It's showing people that we're live, but not on.
Yep, we've got a number of people joining. So Doug, you can hear me, right?
Can you hear me?
Yep.
All right. Haim just sent a message saying he can't see us.
All right, hold on one second. Hey everyone, if you could just type in the chat box if you could see us or not, that'd be great. Just want to make sure that we're live. It's our first time going on LinkedIn Live.
Cool. Looks like everyone can see us.
All right, I think we're live. If you're having trouble seeing us, just make sure to follow me on LinkedIn, and you should be able to see us. So anyway, great to see everybody. Seeing a lot of our contacts and friends. Happy Friday. So like many of you know, my name's Shane Thomas. I'm with Catalyst Equity Partners. I'm a managing partner there. We're a Dallas-based, private equity company focusing on multifamily. I've got a business partner, Prashant. He's based in Dallas, and he'll be responding to a lot of the questions as well. So yeah, we're happy to be here, and we're really happy to be here with our friend Doug Banerjee with Graysteel. So Doug's investment sales broker in DFW. They do business in other markets as well, but we've done business with Doug, and happy to call him a friend as well, and very, very happy to have Doug give us the time today. And so Doug, I guess if you don't mind just introducing yourselves to our viewers, and we'll kind of get going and talk about multifamily.
Perfect. Well, first of all, thanks for having me here, and welcome for everyone else that's watching and viewing online. Like Shane mentioned, I'm Doug Banerjee, Senior Managing Director for Graysteel, and head up the Dallas and Fort Worth office for the firm. We've been in this market since the beginning of 2014 when I co-founded the office, and we have 8 investment sales individuals as well as 8 or 9 debt and structured finance professionals here in the office. And like Shane mentioned, we're based here in Dallas, and we do a lot of sales in the DFW Metroplex, but we basically out of this office cover about a 5-hour radius. So we just closed 2 deals this month in Arkansas. We're active in Oklahoma, East Texas, West Texas, and down through Waco. And we have a separate office in Austin and San Antonio that covers the Central Texas market. So happy to be here, and look forward to the conversation.
Yeah, awesome. And before we kind of get right into it, I just wanted to, in terms of housekeeping, so, let's, everyone should be able to write comments, and, we're going to have, I've got some questions for Doug, but feel free to ask your questions, and, let's make this an interactive experience, and we'll try to get to them as we go through the session. And we plan to be on for 20 to 30 minutes. So I just wanted to throw that out there. So just keep asking your questions. So Doug, I guess, it's obviously, obviously we're in uncharted territory, right? With COVID and whatnot. And it's been an interesting time the last, several months in the multifamily space, in all spaces, right? I think, the first, kind of reaction to a lot of people was, a lot of people just, obviously the country and the economy shut down and whatnot. And everyone were just kind of thinking about, maintaining and obviously preparing for the worst and hoping for the best.
Sure.
It's pretty clear that, some industries, if you think about real estate, like hospitality, hotels and retail, they've got, hit pretty bad with all the travel restrictions. But then on the other extreme, you've got single family homes that are selling, pretty strong. Multifamily pricing seems pretty strong and the demand is high, and industrial seems to have not even missed a beat, right? So you kind of got these two extremes from like a high level. And anyway, from your perspective, we just love to kind of, get a high level, kind of maybe state of, commercial real estate, kind of pre and post COVID, and then specifically multifamily.
Sure. No, I mean, obviously pre-COVID things were very hot the last 5, 6 years, especially here in the Metroplex. Record prices on deals basically in every sub-market. And then COVID hit. And like you said, I would say March, April, May, everybody kind of hit the pause button. They were very focused on operations, and understandably so. So there weren't a lot of transactions other than ones that were kind of tied up pre-COVID that closed out. But as far as new deals, it was a very slow time, for us and our competitors. And then it started picking back up this summer, and I think it's opened back up for sure. Not to the same levels as pre-COVID. I think there's still a lot of folks owners and operators that are still hunkered down and focused on operations and really don't know exactly what's to come because we're still in the middle of COVID. It's not like we're through this thing, right? We're still waiting on a vaccine and whatnot. But the operations as a whole, or the collections, I should say, have held pretty steady across the market. Obviously, you got to look asset by asset. We have seen some deals impacted that we underwrote prior to COVID and that have seen a dip, but a lot of those have rebounded. And what I would say has gone in the favor of buyers or even current owners, we're doing a lot of refinances now too. So that has really picked up as far as refis because you and I discussed earlier this week, I mean, rates in the low 3s or high 2s. We're seeing rates in the high 2s if the property qualifies for a green discount. So that's through energy and water conservation. You can get, as much as a 40 basis point discount because it drops your treasury floor rate, and then you typically get a discount on your spread too. So with high 2s and low 3s fixed for 10 to 12 years, we've certainly seen, I'd say, cap rates stay flat, if not start to come in a little bit because there's less inventory on the market, which just means more competition. So pricing has, in multifamily, certainly held up.
Right. And let's touch on that. So, I mean, you're absolutely right. I mean, I think we've always said the last couple of years, rates can't go lower, right? And I think, yeah, never say never, right? And so, but as an owner, I think one of the, points you made is, obviously we were, when obviously we didn't know what to expect, kind of bracing for impact, if you will, kind of March, April, make sure that we had a good cash position and whatnot. But yeah, like you said, I mean, most of our deals, if you look at them on paper, they look great in terms of collections and NOI. Most of our deals are actually doing, as good, if not better than pre-COVID. But the reality is, if you kind of look behind the scenes, it is taking longer to collect, right? So, we've seen deals where we used to collect, 95% of the money within the first 5 to 7 business days. It's taken us till, the 20th, 25th of the month, right? But, tenants by and large, seem to be prioritizing rent, right? Which bodes well for us. And we're accepting partial payments and whatnot. So I think there's, collaboration between owners and renters, and everyone wants to do the right thing. and obviously the stimulus definitely did help. And so, but, we're kind of now entering a time where, to your point, it seems like inventory is low. I mean, although I've started to see some listings pick up, but are you seeing kind of maybe, buyers that were kind of outside of multifamily, kind of in different spaces in retail and hotel? Are they kind of now opening up and creating more demand for multifamily?
Yeah, no, it's a good point, and we're definitely starting to see that. And I would say buyers from other regions. We're starting to see a pretty big influx of interest from New York, right? Because New York got hit pretty hard with the whole COVID situation, and it's very interesting because we have 14 offices across the country, and every market's very different. Here in Texas, things opened back up pretty quickly, good or bad, right? I mean, from my viewpoint, it's been good for business, but obviously we saw a spike in the COVID cases, a month or so ago, and I think it started to taper down. But in New York, they shut things down, and they really haven't opened back up there. And there's a lot of money up there, right? New York is Wall Street, so there's a lot of capital sitting on the sidelines chasing deals. So we're getting inquiries from family offices up there, institutional money that needs to be placed and put to work. That, yeah, maybe they had a allocation for office or retail or hospitality. They're pivoting and they're looking at multifamily and industrial because those are kind of the two darling products out there right now because they seem to be more pandemic resistant. And so not only COVID, but just other things that could happen, I think has changed the mindset of many investors out there. So I think it is going to create more competition, which once again could just continue to compress cap rates as long as interest rates stay low.
Right. No, absolutely. And I mean, we're seeing that, as a buyer, right? I mean, we're seeing that, the number of, talking to brokers, the number of tours and offers, I mean, they're pretty much, if not at pre-COVID levels, pretty close, right?
They're pretty close. Yep.
And then so, obviously as a buyer, that makes things tougher, but, it kind of gives a good sentiment to multifamily long term, right? I guess one of the questions we wanted to ask was more, do you see any difference in buyer appetite between kind of the different classes of assets, A versus B versus C? Any kind of particular kind of sweet spot, if you will, that people are looking for?
Yeah, I mean, I would say that the Bs and the Cs are more active. Most of the institutions have been sitting on the sidelines. So the big kind of pension fund money, stuff like that, they've been very patient up until now, waiting to see, when this stimulus money burned off, what the impacts are going to be. Because, and they're typically chasing the core Class A deals. And so we're starting to see that loosen up a little bit. But in the B and C space, it's picking up because there's kind of a risk-adjusted return, typically a little higher cap rate, some value add to where you can go in and push the rents or maybe reduce some expenses by, doing some utility conservation efforts, maybe replacing a management company with another one that maybe can run payroll a little bit more efficiently, what have you. And I would say the sub $20 million deals, so kind of what we would call private capital or middle market, those have stayed very active because there's a lot of banks out there that have money that they need to put to work. So even if it doesn't qualify for whatever reason for agency debt, Fannie Mae, Freddie Mac, banks are getting very aggressive in their terms, which is a nice way to bridge to, that permanent debt with Fannie or Freddie or HUD, if that's what he's looking to do. So yeah, the sub $20 million space has stayed active, and I would say that middle market 20 to 50 million has certainly started to pick back up in the last month or so.
Right. And I guess related to that point, so when obviously when COVID hit, I mean, there's been a lot of kind of predictions in terms of with distressed properties and there's been the forbearance and whatnot. I mean, right now from my perspective, it seems like that I'm seeing some deals that potentially could be considered distressed, but I don't think at the magnitude that people were expecting, maybe 6 months ago. And, quite honestly, I'm seeing a lot of deals that are, nice yield plays. But I guess from your perspective, I mean, are you seeing some distressed deals? Do you think there's going to be some opportunities, or do you think that, we're going to kind of, bottoming out and on our road to recovery?
Seen some distress, right? And I would say the distressed deals that we've seen were already a little bit distressed prior to COVID, and that just, exacerbated the problem.
Right.
And so those ones, the folks that took forbearance, those properties I think are having issues naturally, right? If they had to take forbearance, they didn't have enough money to kind of cover their debt, or they feared that they didn't. So those ones are kind of, on the watch list, so to speak. I do think that there's potential that we will see more. Obviously, with the CDC eviction moratorium, time will tell over the next 3 to 6 months how all that shakes out. Because, asset by asset, I wouldn't say kind of DFW as a whole is doing bad, but we have seen certain assets where the tenants, right, they just need to be educated on what that really means. Sure, they can't be evicted, but it doesn't mean that they don't have to pay their rent, and that they're not going to be penalized for not doing so. So I know a lot of management companies and owners and operators are taking those steps and trying to educate the tenants on, well, we'll work with you, but just because it's moratorium doesn't mean that, we can't get you out of the property. So
Yeah.
I still think we have a little bit more time to see how it ultimately shakes out. But my opinion is short term, a little bit unknown, but long term, there's not many better markets than DFW. If you're able to place fixed rate debt for 10 or 12 years at just call it 3%,
Right.
I just don't see how you go wrong, as well as you go in, capitalize on the front end, where you're comfortable and safe. And that's where I think a few groups, maybe they weren't capitalized properly prior to COVID. And, they did distributions on all their excess cash, and they just didn't have enough savings in the bank, because who knew, right? Nobody saw this coming.
Yeah.
And if they did have issues collecting the rent, then it's hard to pay the bills if you don't have income coming in.
Right. So obviously you guys do a lot of business in DFW, but like in terms of like maybe the other major metros in Texas and, even secondary and tertiary markets, are you seeing kind of a different appetite? Have things changed? Because, pre-COVID, a lot of the stuff that I saw was people kind of going to secondary and tertiary markets because they were going to get more yields, right? And then now you could say with COVID, that there's a case to say that that's going to continue because people are working from home more, they want to get out of the big cities, but then, there's also the diversity in the big cities in terms of employment and, if you're going to be able to work. So kind of, are you seeing any differences in those trends?
I wouldn't say difference. You certainly have different buyers looking in the different markets, right? There are those who are focused on the primary markets. And then to your point, if somebody's chasing yield, that's who we're selling to in Arkansas and Oklahoma. Those are naturally going to trade at higher cap rates, and the debt is still very cheap. So you're going to get a higher cash on cash return or yield as far as cash flow goes. But you're probably not going to see as much rent growth in those markets over time. Not a lot of people are factoring in much rent growth in the next year, maybe even 2 years in their underwriting, no matter which market. But certainly that's going to pick back up in DFW at some point, because we're seeing an influx of people continuing to move here. And I think it's just going to force that to happen even more, out of New York, California, where it's very pricey to live, and people are just kind of looking at, their costs. You come down here, it's a little bit more spread out, no state income tax. So that's why I think money from New York and other places are looking to invest here, because I forget who told me this, but they said, if you track the U-Haul prices, right, which direction a U-Haul costs, it's 3 times as much to take a U-Haul from California to Texas than the opposite direction. So obviously that shows that there's a lot of demand for U-Haul to move people's stuff here. And we're seeing companies relocate here. They're kind of tired of the regulations and everything else in those states. So companies move here. That means jobs are moving here, which the people will follow.
Yeah. I'm a perfect example, right? Moved from Chicago down to Texas, right? And you moved as well. So, what are you seeing? I mean, obviously pre-COVID, I could speak for myself. I mean, in DFW and the major Texas markets, I mean, it was competitive to win a deal in terms of terms, right? It was not uncommon for, 6 figures of earnest money, non-refundable day one, right? And so, obviously closing timelines pretty tight and not a whole lot of early access. What are you seeing now, in terms of, obviously we've got restrictions with, the ability to kind of, go into units and stuff like that, and things are just generally taking longer. But what are you seeing in terms of terms now on, offers?
The variance it's very interesting because it's kind of all over the board. We still are seeing hard money, whereas before it was almost a given that to get in the best and final, you had to have some amount of hard money. That's not necessarily the case now. I think track record goes a long way. So, for somebody as brokers, right, we're advising our clients and we are, of course, going to try to advise them on the certainty of execution. So if a group has a track record and, not known for retrading and things like that, those are the things that we're looking for. And obviously hard money can prevent or minimize the risk of that. So we're seeing terms all across the board. So we still are seeing hard money. We're seeing longer due diligence periods, even after the money's hard, because to your point, they might not be able to get in all the units right away. And so have to kind of come back to the property once or twice because maybe some tenants are being quarantined. And so you can't go in their units. And if they want to see 90% or more of the units, which most groups do, there might have to be a couple different visits. So we're naturally working with the on-site management and the buyers to make sure that they get everything done that they need to. And then the closing timeframes, I would certainly say before, a start to finish 60-day close was kind of expected. I think sellers are being a little bit more lenient as far as how long it's really going to take. So if it's going to take 75 or 90 days because the lenders are very busy right now with refis and acquisition loans, sellers understand that. But, as long as the earnest money is hard, either, at PSA signing or a very short due diligence period, then they feel very confident that the buyer's going to perform.
Right. Just quick, if you're just joining us, Doug's leading broker in DFW, works for Grace Steel, and so we're just discussing the state of the multifamily market. If you've got any questions, just continue to write them in. I think, Doug, we've got a few questions here. So I see Zach and Malai. So Malai writes, there seems to be a divergence in the market. Collections are up, rates are low. On the other hand, unemployment is high. The stimulus is going to end, the moratorium. So I guess this question is curious to see where you see, kind of 6 months from now, kind of volume of properties traded and cap rates. So Doug, you want to?
Yeah. So volume of properties traded. I wish I had a crystal ball, right? It's tough to say, but like we've kind of been discussing, things have certainly started to open back up. So I think the number of deals are going to pick up in Q4 compared to the second quarter for sure. And so that'll lead kind of into the sales for 2021. Naturally, we always seem to see a lull come the holiday period, Thanksgiving up through New Year's. So there probably, my guess is, won't be a ton of new listings at that point, but we should hopefully see a lot of new deals come, January 2021. And we've stayed very busy throughout this, providing BOVs, broker opinion of values for owners, and just really advising them on different areas that they could be focused on to increase value and just kind of tighten up their operations. And then as far as cap rates go, I don't see them moving up. If anything, I could see them going down, because if we don't see a flood of inventory, there's still a lot of capital chasing these deals, and that's just going to cause more competition, which is going to push cap rates down, because these interest rates are, I mean, who would have thought 70 basis points for the 10-year Treasury? I mean, not even a year ago, we were at what, 200?
Yep.
So, and there's just no signs. If you look at the yield curve, there's no signs indicating, and the Fed's announced that they're not going to move kind of the central rates until 2023. Obviously, everything's subject to change, but if that holds true, that's kind of their way of, trying to hold things and keep the debt in the wider market cheap, and that's going to cause people to pay lower cap rates, which obviously drives the pricing up.
Right. Yeah, I guess related to that, I mean, it just seems like, obviously the interest rates, are doing some part in propping up the market, right? Your spread between your cap rate and interest rates are, as wide as they've been, in this cycle, right?
Sure.
And so I guess, honestly, on the Fannie and Freddie side, right, there's a lot of liquidity, right? But what are you advising kind of, potential sellers, that may have deals that need to do bridge loans or bank loans and whatnot? Are you seeing, a lot of that activity? Because, as a buyer, I mean, obviously there's just not enough supply in those capital markets, right? It just kind of makes deals a little bit tougher to pencil.
We've been doing a lot of that. So we just provided a balance sheet bridge loan for a large property in Amarillo that just wasn't fully stabilized, but their plan is to go to probably a permanent loan, here in the next 12 to 24 months. But there's a lot of money out there that typically, right, if we're not seeing as many office, retail, hospitality sales, so these different lenders, whether it's balance sheet money or some sort of debt fund structure, they are out there. And what's unique about our firm, on the finance side in particular, we finance all commercial product types. So my counterpart here, Daniel Hartnett, has a 9-person team, and we have individuals that focus on the different product types. So they're in touch with the different lenders, and those lenders, obviously, the bridge, right? They cross all the different product types. So we can really go out there and shop and find some very attractive terms from lenders that most people, I would say, kind of in the multifamily space, aren't going to be familiar with, because they're used to going, if they can, straight to agency. Because if you can go that route, it's hard to beat 3% interest rates.
Right.
But if you can't go that route, we can certainly go out there and shop and find very attractive options, because there's a lot of money out there. And the bridge lenders, I think, kind of shut down for a few months there, like everything else. But they're back in full force, I would say, in the last 45 days. Right.
And I guess another question related to that is, pre-COVID, I mean, before interest rates started going lower, I mean, assumptions where I used to see a lot more assumptions, and, they were compelling, but it seems like now, because the prepays have gotten so high that, it makes it very punitive and it's hard to get those deals done. Are you kind of seeing kind of the assumption strategy just kind of disappear, or there's fewer of those?
I wouldn't say disappear, right? It just kind of depends on the owner or seller's motivation. But naturally, a deal with a loan assumption that has, let's just call it 4.5% to 5% interest rate, fixed rate debt, it's going to have to sell at a higher cap rate, because that spread has to be maintained. So maybe a buyer says, I'll take over this loan because I like the basis, right? If they're getting a lower price per unit, and then over time, of course, that yield maintenance or defeasance burns off. We're working on some deals right now that still have 8 to 10 year terms on what were 10 or 12, year fixed rate loans. And they're attractive from a price per unit standpoint, but, a buyer's going to look at what are their cash on cash returns and things like that. And what kind of pop or, appreciation are they going to make on the back end based on their underwriting. So you just kind of have to really tighten up and look at the underwriting. And, because we have the finance arm, and, I've got an engineering background, I'm very analytical. I study the numbers. I own real estate myself, so I can look at it, through a principal's lenses and say,
Right.
well, if I were to buy this deal, how would I look at this? So we try to look at it the same way. And, we're not going to put a 5 cap on a deal that has 5% interest rate debt, right? Just no one's going to buy that, because then you're feeding the deal. Because cap rate's one thing, but if you really understand the finance, it's really the loan constant that you need to be looking at, and what the spread is between the loan constant, which is like similar to your APR, right? If you're
Right.
getting a home loan, what is your true cost of capital? Because eventually, unless you're in the interest only period, you're amortizing the loan, and your cost of capital is higher than what the interest rate is.
Right. No, thanks for that. We've got some good feedback here. I mean, like, just kind of reiterating a lot of the stuff that we talked about. Somebody said that occupancy is increasing day by day, and I'm seeing that as an owner, right? I mean, our retention rates, they were strong pre-COVID, but they're even stronger now, right? I mean, obviously with some uncertainty, people don't want to move. There's, definitely some delinquency in there and whatnot, but overall occupancies are strong. And so, as we go to kind of maybe, wrap up here as we're hitting 1:30, I think just to maybe summarize, at least from my perspective, and then Doug, you could add yours. I mean, it seems like we've got this, two extremes, right? On the one hand, we've got the job losses, the unemployment, et cetera. But then on the other hand, we've got, very, very low interest rates. We've got, a lot of buyer demand. And so, it seems like, at least from my perspective, I mean, pricing, right now seems to be, at par, if not, even higher than pre-COVID. And, unless there's another shoe that's going to drop in the next, couple months, I would just venture to guess that, we're probably going to, still be in a very liquid market for multifamily, and would love to get your take.
Yeah, no, I agree. I would say kind of par pricing, pre-COVID is about what we'll see, or what we've been seeing, unless there's been a drop in collections that's been significant, but haven't seen too much of that at this point. Yeah, and just more competition because of the lack
Right.
of inventory that's out there. But on Monday we're rolling out a 159 unit property here in North Dallas. It's going to be free and clear of debt. The owner has a bank loan on it, so they'll just pay that off. So that one should be very attractive and compelling to look at. We're wrapping up a deal in Carrollton that we just finished marketing last week, going through the best and final this week, and trying to choose a buyer.
Right.
So, we're doing our job and out there searching for more inventory, kind of within this 5-hour radius of DFW.
Right.
And look forward to working with you and Prashant on some more deals, and anybody else out there that we haven't done business with. So
Yes. No, I was going to say, I mean, if you, obviously you're a wealth of knowledge, if people want to get in touch with you, I mean, where would they go? Can you share your email or website?
Sure. So I think my name is on the screen. So it's Doug Banerjee. My email is just my first initial D, last name Banerjee, at greysteel.com, GREYSTEEL.com. Shoot me an email, connect with me on LinkedIn, Doug Banerjee. So I think I'm the only Doug Banerjee in the world, kind of a funny fact. So it should be pretty easy to find.
Cool. Awesome. Well, thanks again for all of our audience. Hope you got value from this. You can reach out to me at Shane@catequity.com, or visit our website, catequity.com. And, we're happy to, try to add value, and hope you have a good rest of your day. And we'll be back with another segment in a few weeks. So thanks again, Doug. Really appreciate your time. And we know our audience did as well.
Thanks, Shane.
All right. See you guys.
Bye.